The Canadian banking regulator might be clamping down on home equity line of credit as the interest rates are increasing. Let's explore in this video what is a home equity line of credit or HELOC, why they are trying to curb this trendiest form of credit, what possible changes you might expect, and at the end, my perspective about all this. Hi, my name is Sunny and I make content that affect a common man financially. So let's dive into today's topic, changing HELOC rules in Canada. If you're new to this channel, please subscribe to it alongside smashing that like button as that will help me with the YouTube algorithm, which of course will be highly appreciated. As the name suggests, it is called home equity line of credit using which you can borrow against your existing home equity. One of the biggest advantages of buying a house is that you can live in it alongside building a home equity over a period of time. Now, in times of financial emergency, you can access it by taking second mortgage or one-time loan or a home equity line of credit so that you can tide over tough times. In simple terms, the difference between your present value of your house and its outstanding mortgage at that time is your home equity. Banks allow you to take out certain percentage of that home equity with your house as collateral in the form of secured loan where the interest rates offered are usually very competitive. Based on your credit score, the lending bank offers a maximum loan to value according to their credit guidelines, which Canadian borrowers have been using at an alarming rate during the last couple of years. Some people have been using their homes as a piggy bank during the last few years when the house prices were a little inflated while the interest rates were ultra low. Like all good things in life, this party came to an end when Bank of Canada started increasing interest rates recently. Rightfully so, the banking regulator is now worried about these huge HELOC borrowings, which could pose a possible default risk to the banking system in today's increasing interest rate environment. People have been using HELOC for home renovations, buying stocks, or even secondary rental properties, while others have been buying cars, boats, or even using money for vacations. Now, some of it got invested in an appreciating asset, while others are buying things that depreciates over time, which may not be the ideal financial decision. This all increase the leverage which might go out of hand for some people during increasing interest rate environment, especially if they have invested or borrowed beyond their financial means. According to Bank of Canada's data, HELOC accounted for huge spike in residential secured lending this year. There are two possible changes that we can expect very shortly. First, they can change the amount you can borrow against your home equity simply by changing the loan to value ratio or forcing people to requalify when they apply for HELOCs. And secondly, maybe increase the cost for lenders when they do accounting for such loans on their books. In simple terms, they are trying to suppress demand and supply for such loans, where the idea is to protect financial integrity of the system so that people don't overspend and then get into financial trouble, as their ability to pay back will reduce in an increasing interest rate environment, while possibly real estate prices will be falling too. Inflation has hit all major economies in the world, including Canada, much of which is fueled by pandemic shutdowns, supply chain disruptions, loose monetary policy to prop up the economy during such times, and last but not the least, Russia's invasion of Ukraine. In order to check inflation, Bank of Canada is trying to take out excess liquidity from the economy by increasing interest rates. Therefore, in such an environment, HELOC cannot escape scrutiny by the Canadian regulator as they are thinking about reducing the risk. In my limited wisdom, HELOC is just a tool for you to access liquidity from your existing assets, but can be good or go really bad depending upon the situation and how you use it. Leverage is good and that's how banks operate, but over leverage can even sink the biggest financial institutions. It's always advisable to have some sort of financial emergency funds accessible to you just in case, but using HELOC as a credit card or a piggy bank to buy depreciating assets could be a bad idea. If you are financially aware, then using such liquidity to buy an appreciating asset can be a good financial strategy. But if you overborrow against your assets and then tomorrow something goes wrong with the market or the asset you are buying, I'm afraid your financial life can be in a mess. I hope it makes sense as I'm just a random guy on YouTube having an opinion and not even a financial advisor. Please consult one before investing. If you have found value in the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.